What you're about to see in the silver market hasn't happened in over 40 years, and when it does snap, the move will be so violent, so sudden, that most people won't even have time to react. They'll watch from the sidelines as one of the greatest wealth transfers in modern history unfolds right before their eyes. Right now, silver is trading in a range that looks deceptively calm on the surface. But underneath, there's a coiling tension building that's unlike anything we've seen in decades. The fundamentals are screaming one direction, while the price action is being held in check by forces that are running out of ammunition. And when that spring finally releases, the snap is going to catch everyone off guard. Let me show you exactly what's happening beneath the surface, because this isn't just another price prediction or technical analysis. This is about understanding the mechanics of a market that's being squeezed from multiple directions simultaneously, and why the resolution of that squeeze is going to be explosive. First, let's talk about what coiling actually means in market terms. When a market coils, it's building potential energy. Think of it like a compressed spring or a rubber band being stretched to its limit. The longer the compression, the more violent the eventual release. And silver has been coiling for years now, with the tension reaching levels that are historically unprecedented. The physical market is telling us one story while the paper market is telling us another. And that divergence is the key to understanding why this snap is inevitable. On the physical side, we're seeing demand that's absolutely relentless. Industrial consumption is at all-time highs. Solar panel production alone is consuming silver at a rate that would have been unthinkable just 5 years ago. Every single solar panel requires about 20 grams of silver, and we're installing solar capacity at exponential rates globally. But it's not just solar. Electric vehicles use significantly more silver than traditional cars. The average EV contains about 25 to 50 grams of silver in various components, from battery connections to charging systems. And as the world transitions toward electric transportation, that demand is only accelerating. We're talking about millions of vehicles being produced annually, each one requiring silver that has to come from somewhere. Then there's the electronics sector, which has been a steady consumer of silver for decades. But now we're entering the age of artificial intelligence and data centers, and these facilities are absolutely ravenous for silver. The servers, the cooling systems, the power distribution networks, all of them rely heavily on silver's superior electrical conductivity. And as AI continues to expand, so does the demand for the physical metal. Now here's where it gets interesting. While all this industrial demand is surging, mine production has been essentially flat. We're not discovering major new silver deposits. The existing mines are aging, and the ore grades are declining. It takes more energy, more resources, and more capital to extract the same amount of silver today than it did 10 years ago. And with energy costs rising globally, the economics of silver mining are becoming increasingly challenging. But the real story isn't just about supply and demand fundamentals. It's about the structure of the silver market itself and how that structure has created a situation that's fundamentally unstable. The paper silver market, look at what happened during the brief squeeze we saw a few years back. Retail investors coordinated to buy physical silver and take delivery, and within weeks, premiums on physical silver exploded. Dealers were sold out. Mints couldn't keep up with demand. And the price? It spiked hard before the paper market was able to reassert control through massive short positions. But here's the thing. That was just a preview. The real squeeze hasn't even started yet. Central banks are playing a role in this coiling action too, though not in the way most people think. While gold gets all the attention when it comes to central bank buying, silver is quietly becoming more important in the monetary system. Countries are recognizing that in a world moving toward digital currencies and away from dollar dominance, having hard assets matters. And silver, with its dual role as both an industrial metal and a monetary metal, offers unique advantages. The BRICS nations have been particularly active in accumulating precious metals. They're building an alternative financial system, one that's backed by commodities rather than the full faith and credit of any single government. And in that system, silver plays a crucial role because of its industrial applications. It's not just a store of value, it's a critical input for the technologies that will define the next century. Now let's talk about the technical picture, because what we're seeing on the charts is absolutely fascinating. Silver has been consolidating in a range for an extended period, forming what technical analysts call a symmetrical triangle, or a coiling pattern. Each time it tests the upper boundary of that range, it gets pushed back down, Each time it tests the lower boundary, it bounces back up. The range is getting tighter and tighter and the volume is declining, which is classic behavior before a major breakout. But here's what makes this coiling pattern different from typical consolidations. The fundamentals supporting a move higher are stronger than they've ever been, while the forces trying to keep the price contained are showing signs of exhaustion. The short positions on the COMEX are at levels that would be considered extreme in any other market, and those shorts are held by a concentrated group of large institutions who have a vested interest in keeping the price suppressed. Why would anyone want to suppress the silver price? Well, think about what a rising silver price signals to the market. It's a vote of no confidence in fiat currencies. It's a sign that inflation is real and persistent. It's an indication that the monetary system might not be as stable as authorities want us to believe. So there's a strong incentive for certain players to keep a lid on precious metals prices, to maintain the illusion of stability and control. But suppression only works as long as you have the ammunition to maintain it, and that ammunition is running low. The physical inventories that back the paper market are declining. The registered silver available for delivery on the COMEX has been trending down for months. At some point, the paper market loses its ability to set the price because there's simply not enough physical metal to make good on the contracts. Let me paint you a picture of what happens when this coiling energy releases. Imagine you're a large institution that's been shorting silver futures, betting that the price will stay contained. You've made money on this trade for years, but suddenly, delivery demands start increasing. Other institutions, sovereign wealth funds, maybe even a central bank or two, start standing for delivery in size. Now you're faced with a choice. Either deliver physical metal that you don't have, or buy it on the open market to fulfill your obligations. But when you go to buy that physical metal, you discover that it's not readily available at current prices. The refineries are backed up, the mints are running at capacity, the dealers have waiting lists, so you have to bid higher. And as you bid higher, you trigger stop losses on other short positions. Those traders have to cover too, which means more buying pressure. And suddenly you have a feedback loop where rising prices force more covering, which drives prices even higher. This is what a short squeeze looks like, and in a market as small as silver, the moves can be absolutely explosive. We're talking about potential gains of 50%, 100% or more in a matter of weeks or even days. It's not a gradual climb, it's a vertical spike that leaves most people stunned. Now, I want to take a quick moment here because this is important. If you're someone who's been thinking about protecting your wealth, especially if you have significant retirement savings, you need to understand how precious metals can fit into that picture. I've put together a comprehensive guide on how gold IRAs work, how you can move funds from existing retirement accounts into physical precious metals without triggering tax penalties, and what you need to know to do it right. It's completely free, and you'll find the link in the description below. This is particularly relevant if you're sitting on $100,000 or more in retirement accounts, and you're concerned about the direction of the economy and the dollar. Worth checking out if that describes your situation. All right, back to what's happening in the silver market and why this coiling pattern is so significant. One of the things that makes silver unique is its dual nature. It's both an industrial commodity and a monetary metal, and that creates dynamics that don't exist in other markets. When industrial demand is strong, it puts a floor under the price because manufacturers need the metal regardless of the price. They can't just stop producing solar panels or electronics because silver gets expensive. They have to pay whatever it costs. But on the monetary side, silver has thousands of years of history as money. It's been used as currency by virtually every major civilization. And in times of monetary uncertainty, people instinctively turn to silver as a store of value. So you have this situation where industrial demand provides a baseline level of consumption that's relatively inelastic, while monetary demand can surge dramatically during periods of financial stress. And we're entering a period of significant financial stress. The global debt levels are at all-time highs. Governments are running deficits that would have been considered catastrophic just a generation ago. Central banks are trapped between fighting inflation and supporting economic growth, and they're discovering that they can't do both simultaneously. The currency wars are intensifying as nations try to devalue their way to competitiveness, and in that environment, hard assets become increasingly attractive. Look at what's happening with the dollar. For decades, it's been the world's reserve currency, the safe haven that everyone flocked to during times of crisis. But that status is being challenged in ways that would have been unthinkable 20 years ago. Countries are settling trade in their own currencies. They're building payment systems that bypass the dollar entirely. They're accumulating gold and other hard assets as alternatives to dollar reserves. And while this process is gradual, the trend is unmistakable. When the dollar's dominance begins to wane, what happens to all those dollars held overseas? What happens when foreign central banks decide they'd rather hold something tangible than paper promises? The answer is they buy hard assets, and silver is one of the most undervalued hard assets available. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. Right now, it's trading well above its long-term average, which suggests that silver is significantly undervalued relative to gold. Historically, when that ratio gets stretched to extreme levels, it eventually reverts to the mean, and that reversion is usually driven by silver outperforming gold. We saw this happen in the late 70s when silver went from around $5 an ounce to $50 in a matter of months. We saw it again in the run-up to 2011 when silver nearly reached $50 again, and in both cases the move was preceded by a period of coiling, of consolidation, where the market was building energy for the explosive move higher. But here's what's different this time. The fundamentals supporting silver are stronger than they were in either of those previous bull markets. The industrial demand is structural and growing, not cyclical. The monetary system is under more stress than it's been since the collapse of Bretton Woods. The supply situation is tighter because we're not finding new deposits, and existing mines are depleting. And the paper market structure is more fragile because the ratio of paper claims to physical metal is higher than ever. Think about the implications of that for a moment. If you have 100 claims on every ounce of physical silver, what happens when even a small percentage of those claimants decide they want the actual metal? The system breaks. It's not a question of if, but when. And the longer the coiling continues, the more violent the eventual snap will be. Now let's talk about some of the specific catalysts that could trigger this release of energy. One obvious catalyst is a major geopolitical event. If tensions escalate in key regions, if trade wars intensify, if there's a significant military conflict, investors will flee to safety. And while gold typically gets the most attention in those scenarios, silver often outperforms because it's more accessible to retail investors and because the market is smaller, so the same amount of capital creates bigger price moves. Another potential catalyst is a crisis in the banking system. We've already seen cracks appearing with regional bank failures and stress in the commercial real estate sector. If those cracks widen into something more systemic, people will lose faith in the banking system and seek alternatives. Physical precious metals become very attractive when you're worried about the safety of your deposits. A third catalyst could be a major default or delivery failure in the paper-silver market itself. If a large institution fails to deliver on its contracts, if the COMEX has to declare force majeure, if there's any event that exposes the fragility of the paper market structure, confidence will evaporate overnight. And when confidence goes, the rush for physical metal will be overwhelming. But here's the thing about catalysts. You can't predict them with certainty. What you can do is recognize when a market is set up for an explosive move and position yourself accordingly before the catalyst arrives. Because once the move starts, it's too late. The premiums spike, the availability disappears, and you're left chasing a market that's moving faster than you can react. The smart money understands this. They're not waiting for confirmation. They're accumulating now, while the market is still coiling, while prices are still relatively contained. They're looking at the same fundamentals we're discussing and reaching the same conclusion. This setup is too compelling to ignore. Consider the situation from a risk-reward perspective. If you're wrong and silver just continues to consolidate, your downside is limited because the industrial demand provides support. But if you're right and the coiling releases into a major move higher, your upside is potentially enormous. That's an asymmetric bet, the kind of opportunity that doesn't come along very often. And it's not just about the percentage gains, though those could be substantial. It's about what those gains represent in terms of purchasing power and wealth preservation. If silver moves from current levels to historical highs adjusted for inflation, we're talking about a metal that could be trading at multiples of where it is today. That's not speculation. That's just bringing silver back to where it's been before in real terms. The inflation-adjusted high for silver was reached decades ago, and we're nowhere near that level today. Even accounting for changes in industrial demand and market structure, there's a strong case that silver is undervalued by any historical measure. And when markets correct undervaluations, they tend to overshoot in the other direction. So we might not just see silver return to previous highs, we might see it exceed them significantly. Now, I want to address something that often comes up in these discussions, The idea that governments or central banks will somehow prevent precious metals from rising, that they'll change the rules, confiscate metals, or manipulate markets to maintain control. And while it's true that governments have done these things in the past, the reality is that in a globalized world with multiple competing power centers, such actions become much more difficult to implement effectively. If one country tries to suppress precious metals prices or confiscate metals from its citizens, capital will simply flow to jurisdictions that don't have those restrictions. We've already seen this with cryptocurrency regulations, where overly restrictive policies in one country just push activity to more friendly jurisdictions. The same principle applies to precious metals. The market will find a way. Moreover, many of the countries that are accumulating precious metals are doing so precisely because they want alternatives to the dollar-dominated system. They're not going to support policies that undermine the value of the assets they're accumulating. So while there might be attempts to manage the precious metals markets, the underlying forces driving prices higher are too powerful to suppress indefinitely. Let's talk about timing for a moment, because that's always the question everyone wants answered. When exactly will this coiling pattern resolve? When will the snap happen? The honest answer is that nobody knows with certainty. Markets can remain irrational longer than you can remain solvent, as the saying goes. But what we can say is that the longer the coiling continues, the more energy builds up, and the more violent the eventual release will be. There are some technical indicators that suggest we're getting close. The consolidation pattern has been going on long enough that a resolution is due. The volume patterns are showing the kind of compression that typically precedes major moves. The sentiment indicators show that most traders are complacent, which is often a contrarian signal that a big move is coming. And the fundamental backdrop keeps getting stronger, which means the path of least resistance is higher. But rather than trying to time the exact moment of the breakout, the better approach is to position yourself before it happens and be patient. The opportunity cost of being early is minimal compared to the cost of missing the move entirely, and in a market like silver, where the moves can be so rapid and violent, being early is far better than being late. Think about what happened during previous silver bull markets. The people who made life-changing gains weren't the ones who tried to time the exact bottom or wait for confirmation. They were the ones who recognized the setup, took positions, and held through the volatility. They understood that in a market as explosive as silver, you can't afford to be on the sidelines when the move starts. And this move, when it comes, is going to be different from anything we've seen before because of the structural changes in the market. The rise of retail trading platforms means more people can participate. The awareness of precious metals as an alternative to fiat currency is higher than it's ever been. The distrust of traditional financial institutions is widespread, and the technological applications for silver are expanding, creating demand that didn't exist in previous cycles. So we have a situation where the coiling is happening at a time when the potential for a massive move is greater than ever. The spring is compressed tighter than it's been in decades, and the forces that could release it are building. Whether it's a geopolitical event, a financial crisis, a delivery failure, or simply the weight of the fundamentals becoming too much for the paper market to contain, something is going to give. And when it does, the snap is going to be spectacular. We're talking about a move that could redefine wealth for those who are positioned correctly. A move that could validate the patience of everyone who's been accumulating physical metal while others dismissed precious metals as relics of the past. A move that could expose the fragility of the paper market structure and force a repricing of silver based on physical fundamentals rather than paper manipulation. The question you need to ask yourself is this: when that snap happens, do you want to be watching from the sidelines, or do you want to be positioned to benefit? Do you want to be one of the people scrambling to get in after the move has already started, paying premium prices and dealing with supply shortages? Or do you want to be one of the people who recognized the setup, took action, and positioned themselves before the crowd figured it out? This isn't about fear or hype. It's about recognizing a market structure that's fundamentally unstable and understanding that when unstable structures fail, they do so suddenly and dramatically. The coiling we're seeing in silver right now is a sign of that instability. The longer it coils, the bigger the snap will be. And based on everything we're seeing in the fundamentals, the technicals, and the market structure, that snap is coming. The only question is whether you'll be ready when it does.